We begin our second half of the Spring 2 Business Finance 330 course. This is Professor Hassey speaking live and in color from Claremont, California, as we begin 2 weeks of what is called capital budgeting analysis. This week, capital valuation and capital budgeting, chapters 8 and 9. We're going to split our lecture video into 2 parts. Naturally, this lecture video tonight will concentrate on chapter 8, which is a return in the amount of way of calculating investment return on a capital project. And then on Friday, our update on Friday video, we'll talk about chapter 9, discounted cash flow. We have 2 sets of problems to review out of your textbook. Chapter 8, it's problem 1 through 8 on page 263. And on chapter 9, problem 14, pages 296 and 297. These give us great examples of the key topics of these 2 chapters. I have a spreadsheet that we'll review both course lectures, and on Friday we'll walk through that. And the second part of our capital budgeting will begin next week in week 6, where you have chapters 10, 11, and 12, and you'll have assignment number 3 posted next Monday. And that assignment is a spreadsheet formatted assignment. All your work will be very similar to what we're doing in chapters 8 and 9, and we'll talk about that on Friday. But first, before we begin our course, our lecture, many of you are finishing up your midterm examination. I will post the review and the scores by Friday for my updated weekend video. But before we get started, let's watch a very quick video explaining capital budgeting.
The goal of capital budgeting analysis is to determine whether a project is profitable based on today's dollar value. This approach is appropriate because the project costs are in today's dollar value and the expected cash flows from the projects are in future dollar value. To make a decision on whether to accept or reject a project today, both cost and future cash flows must be in today's dollar value. The factors involved in capital budgeting decisions are future sales, expected cash flows, capital expenditure, timing. The purpose of any investment is to generate profit. To generate profit, first the firm needs to generate sales, manage costs, produce positive cash flows that are large enough to recover the investment, and generate profit. In addition, business does not have access to unlimited capital, and the availability of capital will influence the investment decision. The timing of each cash flow affects the present value of cash flow, and the timing of investment will affect the future revenues. Capital budgeting projects are generally classified as replacement, expansion, safety, security and environment, and other. Companies have to replace old equipment because of breakdowns, lower productivity, or technological obsolescence to maintain the production capability of the firm. Replacement projects are the most common capital budgeting project in the business. Expansion project occurs as a result of companies' strategy to produce new product or to enter new market or new industries. A change in environment and government regulation leads to safety, security, and environmental projects. Other projects are research and development projects based on the strategic planning of the firm. The goal of the capital budgeting analysis is to determine the profitability of the project. Profitability of the project is determined by analyzing 3 cash flows of the project. 1. Cash outflows, the money invested in the project. 2. Cash inflows, money generated from the investment. 3. Terminal year cash flows, money received from the sale of the used assets at the end of the project. Let's draw a timeline for capital budgeting project, assuming the life of the project is 5 years. Cash outflows are posted on the left-hand side at period 0. The cash flows are negative because money is going out of the company. Cash flows generated from the project are referred to as cash inflows and occurs after the investment. They are positive because money is coming into the firm. Assuming that the equipment can be salvaged, the salvage value and any other end-of-the-year cash flows from the project are posted on the year 5. The goal of the capital budgeting analysis is to determine profitability of the project. The investment in the project is made on period 0 and the cash flows will be received at a future date. In capital budgeting analysis, all the future cash flows, which is CF1, CF2, CF3, CF4, CF5, and terminal year cash flows for year 5 are brought to today's value by computing the present value of the cash cash flow. The difference between the present value of the cash flows and the initial investment is referred to as net present value. If the present value of future cash flows from the project is greater than initial investment, the net present value is positive and project is profitable. The following are commonly used decision criteria to evaluate capital budgeting project. Number 1, payback period. Number 2, net present value. Number 3, internal rate of return. Number 4, modified internal rate of return. Number 5, profitability index. Payback period. Payback period is the amount of the time required to recover initial investment in a project. It ignores the time value of money. Net present value. Net present value is the difference between present value of cash inflows and present value of cash outflows. Internal rate of return. Internal rate of return is the rate of return at which the net present value of the project is equal to 0. In the IRR calculation, it is assumed that cash flows from the project are reinvested at the internal rate of return. Modified internal rate of return. Modified internal rate of return is based on the assumption that cash flows from the projects are reinvested at the cost of capital, which is weighted average cost of capital. Initial investment is equated to the sum of the future cash flows that were reinvested at the cost of capital to compute the interest rate. Profitability index. Profitability index is the ratio between present value of cash inflows and present value of cash outflows. Project acceptance or rejection criteria. If net present value is greater than or equal to 0, project is acceptable. If the net present value is less than 0, reject the project. Internal rate of return is greater than or equal to cost of capital, project is acceptable. If the IRR is less than cost of capital, reject the project. Modified internal rate of return greater than or equal to cost of capital, accept the project. If MIRR is greater than or equal to cost of capital, project is acceptable. If MIRR is less than cost of capital, reject the project. If profitability index is greater than the 1, accept the project. Profitability index is less than 1, reject the project.
Okay, you might want to watch that video a second time, and I apologize. The speaker of that exercise is talking a little bit too quickly, but trust me, all the information given in that video is what Chapter 8 and Chapter 9 is all about. We'll be practicing them in the 2 problems of this week, number 5 lectures. So this is important stuff. And why is it important? Because the first 4 weeks of our course that was highlighted by the midterm examination talked about the basic fundamentals and definitions of finance. What is finance? Maximizing shareholder value. What is the results of finance? The income statement, the balance sheet, the statement of cash flows, a review of the financial statements that provide the information or trends of what the capital management, the financial management is trying to do with a company. Then we talk about where do you get capital? Bonds and stocks are the main sources of funding for corporations. The borrowing of money through the bond market, the issuance of stock through the stock market. That's capital valuation. And that leads us up to now. What do you do with that capital once you raise it? Where do you invest it? Well, you invest it in assets, assets that produce a return that satisfies the needs of your investors, your creditors, your stockholders. Invested in assets that satisfy the need for growth and supplying capital for growth for your company. And more importantly, making money and making the company more valuable, thus increasing the value of the stock, having you the opportunity to pay back debt, and growing your business. The analysis to pick these assets is what we're talking about in chapters 8 through 12. 8 and 9 this week, 10, 11, and 12 next week. Our topic in chapter 8 is how do you measure those returns? Well, the video you saw gave 5 measurements. We're only going to deal with 4 of those measurements: the payback method, the net present value method, the profitability index method, and the internal rate of return method. Those are the 4 you need to know out of chapter 8, problems 1 through 8 that we're going to practice how to calculate these. It requires spreadsheet work. Do not worry about marginal internal rate of return. And then how do you get those numbers that determine outflows and inflows? That's what chapter 9 is about. Discounted cash flows. How do you calculate the cash flows? Every finance class in the world talks about these 2 main things: return analysis, projecting cash flows off an investment of assets that was funded by mainly debt and equity. So that's where we are in this class. The next 2 weeks, we're going to be talking about this in our discussions, highlighted by assignment number 3 given next week, which is going to cover both weeks. You'll have a significant amount of time to do assignment 3, which will lead also into assignment 4. All right, so that's where we are. So I want you to refer to in your Blackboard, first of all, note the report card on your front page of your Blackboard. Make sure once I post the midterms, you know where you stand in this class through the first 4 weeks of our course. Then go to week number 5. Week number 5 provides you our learning assignments for this week. Remember, there are no grades to do this week. Got the week off, nothing is due, nothing to be posted. It's merely get to know these new topics of capital projects. If you go to week number 5, there's our agenda, which you saw at the beginning of this video. Here's the spreadsheet I'll be working on tonight in my lecture and on Friday. Download that, take a look at it, see if you can do it. It's those 2 problems out of chapters 8 and 9, plus some summary tabs of chapters 5, 6, and 7, just so you can keep the concept of present value in your mind. Descriptions of the work, some additional videos for you to practice and look at, and the PowerPoints and definitions of the 2 chapters. Take a look at this week. Again, no graded work. We're just learning the material and the process. Now we're really going to start using spreadsheets in our class. If you have a question about that, need some help, remember, Wednesday night, 6 o'clock is our student hours Zoom session where you can come on and ask me questions. So let's take a look at our textbook, problems 1 through 8 in chapter 8. As I said earlier, we'll be looking at chapter 8 in our lecture video this evening, and chapter 9 will be our updated video on Friday. 2 videos you need to watch in order to get up to speed for assignment number 3 next week. So here's page 263 and 264 of your textbook. And in this, you're given some information about 2 potential investments, Project A and Project B. Each investment is calling for an investment of capital in the asset of $200 in year 0. That's today. Then the project A and B are projected to generate positive cash flows, that's revenue minus expenses, over the next, for project A, 4 years, and over the next 3 years for project B. Our analysis is to use those methods of net present value, internal rate of return, profitability index, payback to determine the viability of which project should we select that's going to give us the greatest return on our investment. Now, the first thing we should look at before we even start doing the analysis in a spreadsheet is why is one project 4 years and another project is 3 years? That's because the project life is determined by the depreciation schedule of that particular asset. How long you can depreciate the asset is its financial life. Now, you might have project A for 20 years, but as far as financial analysis is concerned and financial management, it's as long as you can depreciate that asset. Project A, 4 years. Project B, 3 years, the depreciable life. Now, in chapter 9, we'll learn how they came up with the $80 a year and the $100 a year. That's chapter 9. We'll wait to do that on Friday. But now we're going to be concerning us to put together an analysis of return on this investment of $200. Is this cash flow over into the future well enough to determine a profitability and return on these 2 different projects? So in that spreadsheet I gave you in class review, video week 5 lecture spreadsheet. Here is the problem for chapter 8 that you just saw from your textbook on page 263 and 264. I put it into a spreadsheet. Project A and Project B. There's the investment of $200 in the asset. And then years 1 through 4, $80, and years 1 through 3, $300, or excuse me, $100 a year for Project B. Couple things you need to know. First of all, you can't do this analysis unless you know the cost of capital, 11%. What does that mean? And we'll learn how to figure that cost of capital in chapters 11 and 12. But the cost of capital is the amount what it cost you to get this $200. It costs this company to find that $200 to invest in an asset that's going to generate this return into the future. It costs them 11% to get that money. So that is your cost of capital. It's also called the discount rate. Okay. Many sectors call it the hurdle rate, the discount rate, the cost of capital, the weighted average cost of capital, the opportunity cost. It has all different sorts of names, but it means one thing. That's what it cost you to get the capital to invest in the asset. So the first analysis we're going to do is determine what is called the net present value. In other words, we're going to determine the discounted cash flow. In other words, take these $80 a year in the next 4 years and discount them back to today, year 0, and compare it to the $200 investment. And the discount rate is the cost of capital, 11%. This is called the net present value calculation or return analysis from chapter 8. So watch what I do. I go to the discounted cash flow and I go to formulas, function, financial, and now I look for the function of NPV, net present value. We looked at this in chapter 5, net present value, and chapter 6. Bring it up, and now we're going to put in the rate. Well, the rate is the cost of capital, which in this case is 11%. Then we put in the cash flow values out into the future. And this is easy, especially if you have the spreadsheet set up properly. All you have to do is under value, go to year 1 and scroll down to year 4. And notice the value goes from B5 to B8. So now what this function and logarithm is going to do is going to take this flow of $320 received over the next 4 years and discount it back at 11% to today's present value. And that is $248.20. In other words, this $320 is actually discounted at 11% to represent $248.20. The net present value is the difference between that discounted cash flow and the investment. Our net present value then is $48.20. In other words, in today's dollars, year 0, when we're making the investment, we say that this has a present value of the whole life or the depreciable life of this asset to be $48.20. Positive. That's a good thing. Now let's do the same thing for Project B. What is its net present value? What's the discounted cash flow? Again, at 11%. Formula, function, financial, net present value. Again, the rate is still 11%. But now the values are for those 3 years, year 1 through 3, C5 to C7. Now it takes those $300 and discounts them at 11% cost of capital, $244.37. Take away our investment, which is the same in Project B, even though they're totally different, and we get a net present value of $44.37. So if I was this company and I was the financial manager, the CFO, the controller, whatever, and I wanted to make a decision. Should we go with project A or project B? Well, the usual answer, the likely answer would be we're going to go with project A. It's giving us a greater return in present value by only $4, but big deal, of $48.20. It's more profitable for us in today's dollars to make that investment. That's the net present value method. It's discounting the cash flows over time at a discount rate called the cost of capital. And again, in chapter 9, we learn how to get these cash flow amounts, how to calculate those. That's what chapter 9 is all about. Another analysis that's given to us, the second one, is called the internal rate of return. This is, what is this $48.20? What is this $44.37 in a percent? Formula, function, financial. Now we look for the function IRR, internal rate of return. Hit OK, and this is a simple one. We don't have to put any percentages in because we're trying to determine the percentage. So under values, you now take from year 0 to year 4. You include year 0, which is the negative investment year. And what is the return over 4 years of this cash flow and the investment? Well, the answer is 21.86%. So this project A investment is earning in dollars a net present value of $48.20, and in a percent, that's a return of 21.86%. Now, what would that be for project B? And the results are going to be a little bit different. Formula, function, financial, internal rate of return. The values now are from year 0 to year 3 for project B. We hit OK. 23.38%. This is interesting. With the net present value in dollars, project A is doing better. But in a percentage, the return is better for project B by a little bit under 2%. Why? Well, it should be somewhat obvious. We're getting the money quicker. It's taking us 4 years to return $320. In project B, it's only taking us 3 years to return $300. We're getting our money quicker in project B, thus the percentage is greater. The internal rate of return. What is the profitability index? Well, the profitability index is the relationship of the discounted cash flow divided by the investment. 1.24 times greater. That's a ratio. Notice when I did the formula, I put in a negative sign before the investment to make that positive so we can see that relationship in a positive number. The profitability index is a ratio of the discounted cash flow to the investment. In other words, the discounted cash flow is 1.24 times greater than the investment. That's the ratio. Well, what would it be for project B? 1.22. In other words, why? Well, the discounted cash flow is greater, thus the ratio is going to be a little higher for project B. That's the profitability index. This is, as you can see what we're doing here, it's different ways of looking at the same numbers. Dollars, percentage, ratio, and the payback is in years. How long does it take us to pay back the investment? So in the payback years, there's no discounting, there's no analysis. All it is, how long does it take us to recoup the $200? Well, the payback in years for project A is 1, 2.5. 2.5 years. How did I get that? $180, 160, $160 have been returned of the 200 by year 2. Now in year 3 it goes to $240, but we only need $40 to hit the $200 amount, which is half of the year 3 return. 1, 2.5 years. Project B, it's even simpler to figure out. 1, 2. It takes us exactly 2 years to return the $200. Again, we're seeing the same pattern. In dollars and in the profitability index, the return in dollars makes project A look better. But in project B, because the years are quicker, the internal rate of return and the payback is better. Interesting. Now, how would a company decide which project A or B to do? Well, it depends on the culture of the company. Let me give you an idea. Net present value is used by Ford. Internal rate of return is used by General Electric. Profitability index is used by Cisco. And payback is used by Apple Computer. Every company has their specific return analysis. Some companies use all 4 or 3 or 2. But some companies say, we're going to stick with the net present value because we have a history of that proving us well in our investment of assets. General Electric uses a percentage. In the real world, General Electric says, we are not going to invest in anything that doesn't give us a return of 25%. So in this case, if this was General Electric, they would say nada. Profitability index, the ratio analysis is used by Cisco. It's their culture. It's what they feel comfortable with in that analysis. That's why we learn all 4, because many companies use different ways of determining return. Apple is big with payback. In Apple's culture, if they don't pay back an investment in 2 years, they don't want to hear about it. If you're investing $500 million in the Apple Watch, if we don't get that $500 million back in 2 years, we're not going to do it. Clean it up. Find a way to do that. So that's why they have these different analyses for the same numbers. Investment return in dollars, net present value. Investment return in a percentage, internal rate of return. Investment return in ratio, profitability index. Investment return in payback years, payback. We need to know all these 4. Here's a nice, short, sweet little way of calculating these. This is your template, and I will save this and post it to Blackboard. On Friday, we'll look at problem 14 in chapter 9, where we have to put together the cash flows of a project, then do the 4 analysis. So we go to the next step. In chapter 9, we learn where these numbers come from and then still do the analysis. If you want to go ahead and try to do that on your own this week in anticipation of Friday, I encourage it. Use this spreadsheet as your template. See if you can come up with it based on your reading and what you see in Blackboard. That'll be a good thing to do. If you don't do that, that's fine. Watch my video on Friday as we walk through this. You're going to be having a problem in your assignment number 3 where you have to do a problem just like this. Determine the depreciable life, the investment, the cash flow, and the 4 analysis. This is what assignment 3 is all about. Okay, so that's the key to this week's first part, week 1 of our capital budget analysis. Determining the return in dollars, percent, profitability or ratio, and payback years. Need to be familiar with each one of these calculations. Try to do this spreadsheet on your own. Use the formulas as I indicated, and you'll be in good shape. Okay, I will look forward to seeing you all on Friday, where look for your postings of the midterm examination results and the solutions. We'll review those on Friday. And also look at Chapter 9's problem page on problem 14 at the end of Chapter 9. Thanks, everybody. We'll see you at the end of the week. Have a great week. Adios.